Okay, so today we're going to be having a look at how to build a property portfolio. So this is a back to basics look at how professional investors start with one investment property and then turn that into a property portfolio that can continue to grow and add to their wealth. So what normally happens is someone comes into the market, novice investor comes into the market with some money. They invest that in a property or some properties, and then that money is kind of locked in there, maybe until we see an increase in capital values. The house goes up in value, and that investor decides to perhaps refinance, take some of the money back out of that initial investment, and go again and add to their portfolio. We're in some interesting times at the moment of, I think it'd be fair to say, fairly uncertain capital growth, certainly in the short term. So that's actually quite difficult to do, and I don't think you would look to necessarily build a portfolio on that basis these days. So we're going to look at a different way of doing it today. But first of all, let's look at some rough numbers of how these investments will look. So let's assume that you come into the market with £100,000 in capital. Now, that's not an insignificant amount of money. And we're going to keep the numbers really straightforward for today. So let's say it's a 3-bedroom house that we're looking to buy. We're going to pay £100,000 for that property. Now, in the current market, it's certainly possible to get away with putting a 20% deposit into the property. So that means you're putting in £20,000 of your own money and borrowing £80,000 against this property. Now, if you're absolutely brand new into this, I need to reiterate that these numbers are not really dependent upon your earnings. Buy-to-let works very different to obtaining a residential mortgage, where they look at how much you're earning, the affordability for you to obtain a mortgage. Buy-to-let is quite different in that they're actually looking at the asset and the house's ability to actually pay for itself. Now, saying that, some mortgage lenders have different criteria. They want you to display a certain level of minimum income, but you really need to talk to a qualified broker about that. So, okay, so we're putting £20,000 of our own money into this property. Leaves us with a mortgage of £80,000. And for simplicity's sake, we're going to assume that we're paying an interest rate of 5%. Now, that's actually fairly in line with some of the rates these days. So perhaps you can do a little bit better, but it's not a million miles off. So some realistic figures. So at 5%, this property is going to be costing us £333 per month in terms of a mortgage payment. Now let's assume that we're renting this property for £650 a month. It gives us a gross profit of £317 per calendar month. Now, this is a gross profit. We will have some other costs to come out of this, which we'll look at later on, but we can immediately see, okay, great, we've put £20,000 in. That's making us a monthly profit. If we were starting out with £100,000 at £20,000 for each deposit, the maths are really straightforward. We can buy 5 of these properties, giving us a portfolio value of £500,000. Let's assume for a second, and it is an assumption, but I think we all get into property because we believe that right now we're buying it towards the bottom of the market. Things are likely to improve. Historically, property has doubled in value around about every 7 to 10 years. So let's just assume for 1 second that it does it again. So in 10 years' time, our 5 properties are going to be worth £1 million. Now, we were looking at interest-only mortgages just now, so we're not paying down the debt on those, which means we've still got 5 lots of £80,000 mortgages totaling £400,000, but we've actually got, over and above those, £600,000 in equity across those 5 properties. And these are making us a monthly gross profit at £317 each of £1,585. So we turned our £100,000 into 5 properties, £600,000 in equity, and just over £1,500 a month in gross profit. Nearly £1,600 a month. Now the problem with this strategy is that we buy these 5 properties, we've used up £100,000, they've run out of money. unless we get this capital uplift and then we refinance. So let's look at a different way of doing things, and this really is the difference in how professional investors work. So we're going to be looking at the concepts of leverage and forced appreciation. Okay, so here we're saying that our house is going to have an end value of £100,000, but we really want something that needs work doing to it. You know, probably looking at repossessed properties, maybe probate cases, stuff that really does need a fair amount of work doing to it. Because these actually, we're able to pick up a bargain price, add value through refurbishing, and force the appreciation of the asset up to the £100,000. So a realistic number on this would be, we'd be looking to buy at around about £70,000. Let's say we spend £10,000 actually on making this a great place for someone to want to live in. Now we know, because we know the area well, that the end valuation is going to be £100,000. That enables us to remortgage to 80% of the end value, £100,000. So remember, we paid $70,000, we spent $10,000 on it, we're remortgaging to £80,000. All of our numbers are the same, so we're still making our £317 per month. But here's the key: we've left no money in this deal. Let's just reiterate, we paid £70,000 for it, we spent an extra £10,000 refurbishing the property. Our surveyor, our valuer, has agreed it's worth £100,000 now, so we can remortgage to 80% of the end value, our £80,000, leaving none of our own money in this deal. Now this is exactly what professional investors do every day of the week. Why is this great? Well, actually, what this really means for you is that you can keep buying more and more properties. So you take your initial £20,000, recycle it, put it into the next deal, and go again. This is great. You never run out of money. You can keep building your portfolio. And this is exactly what a professional investor does on a day-to-day basis. Okay, so we looked at the gross profits just now of £317 per month. But we need to be pretty brutal and put in some realistic costs here and see what we're actually going to be making. So first of all, let's look at the interest-only mortgages. Now, a lot of investors choose to go with interest-only because actually it's easier to get the deals to work. They're banking on the properties going up in value in the future. So let's look at these. So we're renting for £650 a month. Our mortgage is costing us, as we know, £333 per month. Our gross profit is £317, but we now need to start taking out some realistic costs. So it might be that you choose to rent the property yourself, manage the property yourself, or you may enlist the services of a letting agent. If you enlist the services of a letting agent, you're going to be paying around about 10%. So that's costing you £65 per month for your agent to manage this property for you. It's also fair to say that we need to allow a budget for any void periods, any maintenance, any repairs that need to be done. These things always happen, gas safety checks, so we need to put in a realistic budget for these. So let's say 20% of our gross rental figure. Now that kind of seems high to some people, but actually across my portfolio I have found that that's a fair number to allow for, which will also enable me to refresh the property every 5 years, keep it up to date, keep it to a really good standard. So okay, so at 20% that's another £130 per month that's coming off our gross profit, giving us a net profit of £122 per calendar month. Now remember, in the first instance where we were leaving money in the deal, we would have been looking at a cash-on-cash return. You know, we were leaving £100,000 in 5 properties. As a professional investor, we were looking to get as much of our money back out as possible and move on to the next deal. So actually, if our property has none of our own money left in it, it's making a monthly net profit, then our returns are infinite. Some investors out there prefer to look at an alternative to interest only, and that's actually repaying the mortgage, paying down the debt. Now, this is something that probably we do more often on our own residential mortgages. You know, we get one house and we work towards paying that mortgage off as quickly as possible. So the first figures are all the same, £650 a month, except for our mortgage. If we're repaying the debt, this is going to be costing us over 20 years £467 per month. So we still have a gross profit in here of £183 per month. Now we need to take off exactly the same figures as we did before. So we have a net loss on this property. Now it's £12 per month that this property is going to be costing us to own. However, does that make it a bad strategy? Well, it really depends why you're investing. If you're investing for cash flow now, it's almost certain that you're not going to be going with repayment mortgages. Interest only are the norm for most buy-to-let investments. However, if you want to end up with an unencumbered, debt-free portfolio in 20, 25 years' time, whatever it is, you may be looking to go down the repayment route. So yeah, okay, this property is costing us £12 a month. Is that any bad thing, really? This is actually a different type of investment. We're not looking to make an income from it. There's generally two types of investors out there. Those that would fall into interest only, that are looking to generate a revenue from their properties right now. And the second would be probably people with higher incomes that can maybe afford to subsidise properties to a small amount, and it should be a small amount, in this way, to end up with a debt-free portfolio. Okay, so before we wrap up, we need to look at where you're going to be buying these property. A few golden rules. Firstly, buy where the numbers work. You've seen some fairly basic numbers in the video today. You've perhaps seen some of the other videos that we've run before in the past on how to get your deal to stack or how to assess your investment area. If you haven't looked too much into areas, you really need to start crunching the numbers. Don't go investing places where you're going to have to be subsidising your properties by £100, £200, £300, £400 a month. That's a really good way of going broke fast. And buy near to where you live. Now, that doesn't mean that you need to be buying on your doorstep. It's a really good idea, though, that particularly if you're starting out, you buy within a 45-minute drive or travel time of your own home. Starting out, particularly if you're going to be managing refurbs, you're going to need to be at the properties. Definitely, if you're going to be managing properties yourself rather than enlisting the services of an agent, then you're going to need to be at that property to do viewings, to organise maintenance, all these kind of things. So it makes a lot of sense to buy near where you live. Now, if you've been doing this a while, it's actually okay to buy a little further afield if you're enlisting the service of an agent or if you're a bit more experienced. But it would be our recommendation that you always buy in one area, or if you have a larger portfolio, in a couple of areas. Really do not want to be taking that scattergun approach of buying one property in Cornwall, one property in Edinburgh, one property in the Midlands, and having places all over the country. You're going to get no economies of scale, and property management is going to quickly become a nightmare for you. Okay, so we've given you a very, very quick overview of how professional property investors work today, how they start off with maybe £20,000, £30,000, whatever that pot of money is, and they turn that into multiple cash-generating properties or multiple properties where the debt is being paid off by the tenant. So, if you are new to us, you've not seen the magazine before, we would urge you to subscribe to Your Property Network magazine. You get your first copy free of charge. We have in excess of 50 hours audio interviews and video interviews with very, very experienced investors explaining exactly how they make money out of property. There's no contract period. You are free to cancel the contract at any time, and you do get your first copy free of charge. So get online, join 10,000 other investors who are learning to make serious money out of property. I hope you've enjoyed this video, and I look forward to talking to you next time.